Well, I have the pleasure, I'm very proud to introduce Philip Lane as the keynote speaker for this conference. I think, Philip, there is very little need for an introduction to Philip. He is an executive board member of the ECB, the chief economist of the ECB since 2019. He was the governor of the Central Bank of Ireland from 2015 to 2019, and he has a long career at the Trinity College in Dublin. So given that everybody knows Philip, I thought to create value in this introduction, I'm going to introduce you Michelle Smith. I don't know who knows Michelle Smith, an Irish woman here in the audience. Well, Michelle Smith is the Irish woman who has more gold medals in the history of Ireland. Three gold medals in the Olympics. Well, Philip has 2 gold medals in his CV, and he is also the first Herman Bernather laureate. Herman Bernather was the first Director General in Economics at the Banco de España. He was the founder of the Servicio de Estudios, and Philip is the first laureate with this award. This is like the John Bates medal in the US, so this makes the 3rd medal for Philip, so he is the Irishman with more gold medals in Ireland. So Philip, thank you very much for coming here, and we are very pleasant to have you here and hear your speech. Thank you.
Thank you, Angel. I've never been introduced like that before. I would have to reflect on that one. So let me thank Pablo, everyone here at the Bank of Spain, at the Irving Fisher Committee, and of course at the ECB for asking me back to speak to this conference. Of course, during my career, usually with Jean-Maria, who's also here for the last nearly 30 years at this point, we've been very interested in cross-border financial positions, cross-border financial flows. And of course, many of these issues arose when I was Governor of the Central Bank of Ireland, and when I chaired the committee to review how to make statistics useful for policy making in the world we live in. And I think this morning what I want to do is try and illustrate from a policymaker point of view how to think about the data we receive, because I get many data releases come across my desk, including the reporting from my colleagues in statistics at the ECB about the balance payments on the IIP. So what I want to do is actually it's been interesting recently, and to try and convey how to use the data while knowing all of the limitations that we had in the last session, and how to think about it from a policy perspective. Now, if you look at the international financial flows for the euro area, this goes back to the start of the euro. What you see, I think there's a few messages from this. So the blue line is acquisition of foreign assets, and then the liabilities are in orange. So maybe number one is these are big numbers. So if I eyeball that, I say more or less the average 12-month figure is about €1 trillion, which is a large amount of financial flows. So understanding this is important because, directly from a monetary policy point of view, maybe there's not a direct mapping, but the extent it influences term premia, equity values, that's very important. See, even at a business cycle level, it's important. But then it's very important, of course, for exposure to all sorts of shocks. Now, what I'm going to focus on today is what's happened in 22-23. But I will say in early 2020, when the pandemic hit, and Martin Schmitz knows because I turned to him to look at it for me, is we really need to know very quickly whether the pandemic was also a cross-border financial shock. And to understand the flow data from the BOP as quickly as we could was very important. So these episodes can be defining episodes. So, I mean, everyone knows there was a huge literature triggered by the planned, well, first, I mean, Pablo this morning talked about the run-up in capital flows before the global financial crisis. Here I'm looking at gross flows. Of course, there's very big net flows, big current account deficit in some countries. But then from a capital flow point of view, the collapse, very rapid collapse in 0809 in gross flows was really triggered a lot of research. Then what you see since then is they kind of stabilized at a kind of average level, very similar to the pre-global financial crisis level in the grand scheme of things. And yes, there was some wobbles at the start of the pandemic, but look at the scale of what happened in 2022. So there's a really big retrenchment in assets and liabilities in 2022. Now, in 2023, there has been some recovery from that. And so this is interesting. What might have driven this? How do we think about it? And of course, in 2022, there were two big events. Well, more than that, but two anyway. One was the Russian invasion of Ukraine, which you might think about just a very big increase in geopolitical risk in decision making. And then, of course, with the increase in inflation and monetary policy response. So after a long time when the monetary policy was essentially both through QE, so the euro system was dominating the European bond market, and also with very low interest rates, the level of interest in cross-border financial flows was low. But in 2022, with the end of QE, the start of raising interest rates, both in Europe and around the world, there was some change there. So I think this episode, we're still in it, it's revealing a lot. So when you do have a change in the environment, trying to ask, what does the flow data tell me, I think is quite important. Okay, so then, of course, the first question you might ask is that even across the different components? So the classic components between direct investment, portfolio, other, which of course there's a lot of bank debt flows and so on. And this graph gives you the history where you can see, for example, before the global financial crisis, there's a lot of cross-border bank flows, which greatly diminished thereafter with the retrenchment in international banking. But in the more recent episode, you do see that there's some mix across the different categories. It's a bit hard to look at these the most recent episodes, so I'll get to the more detailed breakdown in some subsequent slides. Now, this morning we already heard about the role of investment funds. So, of course, this is a kind of not an issue about the ultimate, but in terms of the proximate actor here, the proximate intermediaries. What you see here is the scale of investment funds in portfolio flows, and also the pro-cyclicality. I think this is important to I mean, it provides you a clue. Where should you look? And what you see here is that a very large fraction of overall flows relate to investment funds, and maybe it's not jumping off the page here because they're so big, but they fell disproportionately more than other categories in 2022 in terms of the flows. So then the question is, because you heard this morning, well, these investment funds are partly held locally, partly there's non-euro area investors using euro area investment funds to invest around the world. So partly it's, the euro area is a pass-through vehicle for some of this. and I'll come back to it later on. But it's important, really to understand that investment funds have a particular investor base compared to, for example, like an insurance company or a bank. So in other work in finance, including by one of my former students who's at the Fed, Yannick Timmer, understanding the liability structure of these different intermediaries. Basically, do you have sticky investors or investors who respond more quickly to geopolitical risk or to changes in interest rates? And on the liability side, and again, we're limited, and we'll hear later on today from John Maria, and we already heard to some extent about missing liabilities. Understanding the liability side that does have holes in it because of custodian issues and other issues. But what you see here is the, again, very visible decline in equity flows during the 22, which has started to pick up now. And again, most of you can ask, okay, what was it about the community of people who invest in investment funds that led them to have this retrenchment? Another way of saying this is, and for me, I think it's been important in recent years, because now the euro area has pretty good sectoral financial accounts. And so embedding the external account with the array of sectoral financial accounts is quite important. Because in the end, you want to know who is the decision maker, why are they making these decisions. I've given you already this limitation that there are non-euro area investors in these European investment funds. But short of that, it helps you to shine the spotlight about what to look at. Maybe I would also say on the debt side that the turnaround here is where monetary policy maybe you might think has played a role. So what you see in 20 at the start from late 22 onwards and strongly in 23, there's been a big increase in foreign investment in euro-denominated, in euro area debt. The green is sovereigns, the blue is bank bonds. And of course, economically, this lines up. When we started to raise interest rates, euro area debt became interesting again for the foreign investor. So here, there's a fairly, I think, direct relationship. So, in mid-22 or early 22, many people were asking, what happens to the European bond market when the ECB steps away? So when the euro system ends QE, there's still a lot of issuance. How does the European bond market find an equilibrium? And the answer, in part, is the foreign investor returns. The foreign investor returns, and here the scale of it has to be connected to price sensitivity. At what level of interest rates does the foreign investor return to hold European debt? Now, it's also the case the rest of the world was also raising interest rates. So we also saw an increase in outward flows as well. So there's a kind of, you have to think about the portfolio balance here between domestic and foreign. You also have to think about around the world, those who have raised interest rates more than we did, whereas those who did less. And of course, it's compared to longer term expectations. And of course, one of the themes the markets have been studying is the role of Japanese investors, where even though the BOJ has not yet raised rates, the longer term expectation has changed compared to where it was. Okay, let me also say that, I've given you a category breakdown there. It's also interesting to think about the geographical dimension. Now, again, with the limitation of trying to find the ultimate destination as opposed to the proximate destination. So with that caveat in mind, maybe a couple of things to point out here. So first of all, you can see here for equity, the scale of the US in equity outflows from Europe. which of course, this is where the most successful firms are. It's the biggest equity market in the world and so on. But you can also see in the retrenchment in 2022 was compared to very strong flows in 21, a big retrenchment in 22 out of the US especially, and to some extent out of the UK. So again, trying to find an analytical framework to think about this, I think is important. And I'll come back to it later on. Is it something to do with exchange rates? Is it something to do with other types of macro exposures of European investors? But to the extent that kind of non-uniformity informs you about what drives decision making among investors, I think that's relevant. And then on the debt side, let me emphasize adding the light blue, the light green and the dark green together. If I have I'm a little bit colorblind, but I'm going to claim that emerging developing economies are dark green and light green is offshore centers. And it's very important to think of those together, because what we've seen is the kind of pullback in 2022 from the sum of emerging markets and offshore centres. And this is where maybe the geopolitical risk factor emerges. Because we know a lot of corporates in emerging markets issue debt via offshore centres. So, we heard this already this morning. If you want to track overall exposure to emerging markets, you have to allow for the indirect via offshore centres. But again, that's a very natural, economically sensible kind of, I think, interpretation. So again, I think this breakdown provided now, where you can do this geographic breakdown, I think is quite important. We also heard, and we will hear more, I think, later in the conference about FDI. And this breakdown, I think, is quite important, is thinking between the FDI conducted by non-financial corporates, the dark blue, and the FDI conducted by other financial institutions, which includes special purpose entities. So here you can see that the big decline in 2022 was by and large a big decline in terms of the financial type FDIs going through SPEs. So of course, economically, I start off by saying geopolitical risk is a big factor maybe in 2022, given what happened. And yes, the FDI through the non-financial corporates also came down, but probably you want to think about the geopolitical factor operating via both channels, both through the kind of real investment, if you like, the where to put locate an operation, a plant, or other type of operation, and then in terms of the financial engineering through the SPEs. And on the liability side, you also saw a big shrinkage in terms of, and again, this is maybe interesting in the sense of with sanctions, for example, or other reasons, in terms of the level of interest in using European locations for financial type FDI by non-Europeans. You might think that's makes sense. But I think this is very important to remind people who look at the raw data. You need to make this breakdown, because we know the FDI data really has two categories, and these two categories interlink, but they provide interest by looking at them separately. Let me also, this is a correlated point, because again, this is the geography of FDI, and what you see here is on the asset side, a pullback, especially from the UK in this latter period, and from the US to some extent. And on the liability side, again, I would also say the pullback from offshore centres investing into the euro area in terms of FDI maybe interconnects with this geopolitical risk factor. Let me also highlight another new type split of the data that's now available, from the ECB, which is lower rated versus higher rated debt securities. And again, what's happened this period, even though I should have done it in delta, not level, to make it more visible, is a decline in the holdings of higher risk securities, again, over this recent period. And again, if what's happening here is an increase in risk aversion, or at really some other way of thinking about heightened risk management, it makes sense that the pullback is going to be more from lower rated debt than from higher rated debt. Let me also say, coming back to the analytical agenda, so far I've focused on flow data, but it's important, and you can see here the overall dark blue line is the overall change in the net IIP over the years, and you see this big decline again in 2022. But it's very important to remember, given the very high stocks of gross assets and gross liabilities, all the different components of valuation changes play a big role in these net IIP changes. So the blue lines are basically the orange are the transactions. But you can see big swings in the euro dollar have mattered in 22 and partly reversed more recently. And also there's been movements in valuations of stocks and bonds in this period as well. So again, when you have an interest rate cycle, when we know raising interest rates means there's a decline in bond values, we know the stock market has behaved differently in different countries. When we want to think about wealth effects, this is quite important. So now there's a mini industry about the distribution of the impact of inflation. And there is a cross-border element to that, in the sense of modelling the cross-border transmission of the valuation changes from well, of course, there's a real nominal issue about directly, if you hold a nominal debt in a country, the real value of that when inflation changes, but there's also the associated interest rate change which happened. So I've kind of raced through, I suppose, maybe it's of value to everyone in this room to know what it means is central banks and other kind of policy authorities really need people who know the BOP and IIP. So this is kind of an endorsement of the workshop and the work you do, because just looking at the raw data is not informative. You need to look at the cuts of the data that we have. And it cannot be, I think, so far just relegated to ChatGPT. Well, maybe that day will come when they will be able to do all of this. And I do wonder about the anonymity restrictions or the confidentiality restrictions with AI agents as opposed to human beings. But in any event, I sometimes do get, and I think anyone who's working today have got over the decades, this is making my head hurt. I'm just going to ignore it. I'm going to ignore all of these complications. That is not the answer. The answer is you do need to be able to communicate and to walk through, especially, and I do think it's informative, to focus in on episodes. And again, I very briefly highlighted here the swings in 22, 23. And of course, let's see what happens this year. And I think these new data cuts are helpful, but let me just finish with a couple of other points on this. So I think it's important in relation to the issue about SPEs and so on that we need to do more. We need to do more in terms of the impact of multinationals on production and investment. And what I mean by that is we need to do more to integrate the not only, I suppose, the data, but also the communities of people who jointly look at the BOP and the national accounts. Because in the end, those intersections are quite important as well. Let me also say, and Pablo in his opening also remarked about the potential for, trying to be agile and bringing in administrative data of different types would be really, I think, important. I think it's very important is to improve cross-border data sharing, especially, of course, globally. You can think about it, at the very least within the Eurosystem, there should be more data sharing possible, which may require kind of new legal bases for that. Again, coming back to new opportunities through IT, new versions of IT that would help. And I think globally it would be good, but again, at the EU level, if we could move to a single reporting basis for multinationals, and again, Pablo connected to what we're doing now at the Eurosystem with the banking system through IRET, but more generally, if the multinationals were able to report in a kind of single way to the EU, that would really help from our point of view. So let me maybe just stop there, because there's going to be so many different sessions today and tomorrow. I think I'll come back to many of these topics. So with that, let me close.